Welcome back to the Global Ledger. I'm Justin. In episode 37, we broke down the hidden signals that tell you when a crisis is starting, long before it hits the headlines. Today, we're going to explore the opposite side of the cycle, how crises actually end, how the financial system stabilizes, how the hierarchy of money repairs itself, and how markets reboot after the deepest liquidity breaks. This is the part almost nobody understands. Not traders, not most analysts, and definitely not the media. So, crises don't end because confidence returns. They end because balance sheets are repaired and the hierarchy of money re-expands from the top down. Let's get into it. Crises don't end in the stock market, and they don't end in the economy. They end in the plumbing. Collateral restored, funding stabilized, settlement certainty regained. When the bottom of the hierarchy collapses, the crisis begins. When the top of the hierarchy is restored, the crisis is over. Let's walk step by step through this reboot sequence. And I think maybe we should start with first and foremost, the Fed. Definitely an important player, an important part, I should say, of restoring par at the top. So the Fed stops the fall. In every crisis, 2008, 2020, 2023, stability begins with the Fed restoring the top of the hierarchy. Repo operations, discount window lending, swap lines, emergency liquidity facilities, treasury market support. These tools are not printing money. They're restoring par, the ability of lower level promises to settle. Think of it this way. A crisis is the failure of promises to clear. Ending a crisis is restoring the capacity to clear them. The Fed gives the system the one thing it has lost, a reliable settlement asset. And this is reserves at par. This is the anchor. A destabilized collateral market is a crisis. So crisis end when treasury liquidity returns, haircuts start to stabilize, repo spreads normalize, and forced selling stops. In every episode, or every major episode, I should say, 2008, Fed guaranteed agency MBS. In 2020, the Fed backstopped money markets and treasuries. And another one in 2023, the BTFP facility, more of a program, but stabilized bank collateral losses. So once collateral can trade without blowing up funding markets, panic begins to subside. Because if collateral can't be financed, the system cannot function. So we need to include dealers. Now we need to talk about them. They need to be able to regain balance sheet capacity. So dealers are the market makers. And they pull back during stress. They shrink, they widen spreads, they reduce risk-taking, and they hoard collateral. Crises end when this reverses. Signs that the reboot has begun. Market depth starts to increase. Bid-ask spreads narrow. Hedging becomes cheaper. Swap spreads move back to normal. FICC clearing volumes start to stabilize. This is the moment liquidity returns. Dealers are the hinge between the Fed and the market. And when they re-expand, the system re-expands. Let's talk about the funding markets for a second. Crisis spread upward through this hierarchy. Repo markets destabilize, money markets seize, commercial paper issuance starts to collapse, bank funding becomes stressed, deposits move, credit spreads explode. Ending a crisis is the reverse. So repo normalizes, money markets reopen, CP issuance returns, deposit flows stabilize, and credit spreads tighten. Each layer of the hierarchy must heal in order. And that's an important statement. And it must do it, it must heal in order. So they can't jump from panic to recovery. The system must re-inflate through each layer. Let's transition from plumbing into markets. So once funding stabilizes, volatility starts to decline, liquidity improves, and margin calls stop, right? So this is the tipping point where markets stop pricing fear and begin pricing fundamentals again. So it's not about optimism, it's about mechanical restabilization. The discount rate, discussed in episode 10, finally begins to fall back toward normal. And when the discount rate falls, valuations rise. Not because sentiment, improved, but because funding costs started to normalize. The real economy reconnects to markets. So this is kind of step 6, I should say. Crises break the connection between credit, spending, investment, production. Once financial plumbing is stable, borrowing resumes, corporate cash flows normalize, and economic activity starts to rebound. So this is why markets recover before the economy. Plumbing heals first, markets heal second, and the economy heals last. So the hierarchy here re-expands from the top down. So now the reboot completes. So central bank money stabilizes, bank money stabilizes, shadow money stabilizes, and market credit stabilizes. Each layer leans on the layer above it. Once the top is guaranteed, the structure kind of starts to feel back in. This is the re-expansion of this hierarchy. So and until the re-expansion happens, the crisis is not truly over. And I think what people misunderstand is crises don't end because confidence returned or sentiment improved or even the market liked the news or something like that. So crises end because collateral regained value. The funding markets, they stopped breaking. Dealers could intermediate again. And the Fed restored settlement, risk premiums normalized, etc. So emotion is the surface, but plumbing really is the cause. And just like the beginning of a crisis, the ending is mechanical. So if you understand this reboot sequence, you'll see the financial world differently. You won't mistake volatility for chaos. You'll know what to watch. You'll understand when the storm is passing before the headlines reflect it. Because you're watching collateral, you're watching funding, you're watching liquidity, you're watching swap lines, dealer balance sheets, market depth, risk premiums. You're watching this, not the hype. And that's the core of what I try to bring to this show. So thanks for listening to episode 38 of The Global Ledger. We walked through the mechanics of how crises actually end, how liquidity is restored, how collateral is stabilized, how dealers regain capacity, and how the entire system of money reboots. In the next episode, episode 39, we're going to explore why crises have become faster and more violent in the digital age, and what it means for the future of financial stability. Once again, I'm Justin, and thanks for being here.